Hello, everyone. I am Dr. Hela, and I would like to thank everyone for attending my session, where I am going to talk to you about the problem of illiquidity on stock market and its consequences on the return of investments. It is an important and interesting subject because it's by understanding the nature of the relationship between market illiquidity and stock prices that we can best ensure our profitability from investment strategies and avoid high costs on stock markets. Let's start by understanding the concept of liquidity on stock market. Market liquidity is a feature of a market whereby the investor can quickly purchase or sell its asset without moving prices and without incurring significant transaction costs. However, believing in the ability to trade without causing a drastic change in prices and at all times without bearing significant transaction costs can be a pernicious threat to financial stability. Indeed, even market liquidity is a precondition for market efficiency. Its sudden disappearance may escalate into systematic crisis. And this is what several research revealed from the analysis of previous financial crises and previous stock crashes. Several research revealed that market illiquidity was often involved in the major global financial crises and stock crashes. For example, the 1987 stock market crash, where market illiquidity was the driving force behind the fall in stock prices. And this was due to changing investor expectations about the New York Stock Exchange liquidity. This is proved by Amihud, Mendelssohn, and Wood in 1990. A second example is related to the long-term capital management, the LTCM, which was the most prestigious fund of the Wall Street. The study of Aragon et al. In 2012 revealed that market illiquidity caused this fund to go bankrupt in 1998 when the fund's traders were irrationally involved in huge leverages positions. Market illiquidity was also at the heart of the global financial crisis of 2008, according to the analysis of Peterson in 2009. And this was mainly due to market of credit derivatives, known for its strong liquidity, that became illiquid in June 2007 when subprime loans were revealed to be toxic. Also, the study of Caio et al. In 2020 showed that the Chinese stock market crash in 2015 was triggered by the irrational rejection of stocks by inexperienced Chinese investors and sensitive to remorse. And this prevented the Chinese stock market to absorb their massive sales. Actually, illiquidity is a multi-dimensional concept. But in my study, I focus on the notion of market illiquidity shocks, which are described by the inability of market to absorb order flows without causing violent price adjustments. And these price adjustments are more or less violent depending on liquidity degree of the asset, according to some studies which state that the smaller the economy, the company, the most illiquid its stock and the most impacted by market illiquidity risk. These statements have led me to examine the relationship over time between market illiquidity shocks and stock returns on the Saudi Stock Exchange. Why the Saudi Stock Exchange? Actually, there are three main reasons. The first reason is that the impact of market illiquidity on stock prices is often verified on US markets, which are arguably the most liquid market in the world. While on emerging markets, illiquidity is an important issue. The second reason is that in recent years, major transformations have taken place in the Saudi stock market, which lead to changing in the investment process. And among these changes, the openness to the foreign investment and the support of investment in small, medium enterprises in order to diversify the Saudi economy. As you know, in response to difficulties faced by the Kingdom of Saudi Arabia following the sharp drop in oil prices in 2014, the KSA seeks to reduce the country's reliance on oil by diversifying the economy and boosting investments in the private sector via the small medium enterprises. So concretely, I investigate if market illiquidity has an impact on stock returns of Saudi small medium enterprises, and whether this impact depends on the size of the enterprise. In other words, if this impact differ between small and medium enterprises. So similar to any research work, my study is based on a literature review, but unfortunately, the time of my talk is limited. So I move directly to, especially this formula. It's very important. This formula shows the beta illiquidity, which was developed by Pastor and Stembo in 2003. The beta illiquidity is similar to the market beta, except that the sensitivity of returns is rather to illiquidity shocks and not to market returns. So beta illiquidity is the measure of illiquidity risk. And for interpretation, we say that the higher the illiquidity beta of the asset, the higher its illiquidity risk. That means the more sensitive its return to illiquidity shocks. So I move directly to the empirical study. I focus on Saudi small, medium-sized enterprises whose stocks are continuously listed on the Saudi Stock Exchange from 31 December 2014 until 1st July 2020. 20 Saudi small, medium enterprises are selected after removing those without daily returns and without trading volume during several days. This is in order to make estimates parameters of the model more reliable. So finally, we return 17 medium enterprises and 3 small enterprises. The first step in my methodology is to measure the illiquidity level of each stock. In this way, we use the illiquidity measure of Amihud of 2002, which is a proxy of the impact price. The measure of Amihud is the average of the daily return to volume ratio weighted by the reverse of the number of trading days. And this measure allows to capture the impact of order flow on the stock price. Market illiquidity is measured at weekly frequency as follows. And the second step is to estimate illiquidity shocks, which represent the unpredictable or the unexpected component of the market illiquidity. So we seek the model that can predict the market illiquidity in order to extract the unpredictable or the unexpected component from this model. Okay, so we find that market illiquidity on the Saudi Stock Exchange can be predicted using the autoregressive model with 5 lags. So from the autoregressive model, we extract the estimated innovations which represent market illiquidity shocks, residual or innovations. This figure shows the estimated innovations in Saudi market illiquidity. We see that the highest peak in early 2020 coincides with the coronavirus pandemic and the fall of Saudi stock market by roughly 27% in the first quarter of the year. In the third step, we estimate for each stock the relationship between illiquidity shocks and stock returns using this regression. Especially beta S is the illiquidity beta, which measures the illiquidity risk. Concretely, it's measured the sensitivity of realized stock returns to unexpected market illiquidity shocks, designated by CLIC. This table summarizes our first results. We see that all beta illiquidity are statistically significant and negative. This indicates that the relationship between stock returns and liquidity shocks is negative for the sector of insurance. Same results for the other sectors of the Saudi Stock Exchange, except for the sector of real estate. Indeed, the relationship between illiquidity shocks and stock prices is significant and negative, except for small and medium enterprises of real estate sector, where the coefficient is revealed not significant. The last question in my study is whether the relationship between illiquidity shocks and stock returns differs between small enterprises and medium enterprises. For this, I classified the sample in two portfolios according to the classification of the Saudi General Authority for small and medium enterprises, and I compute the illiquidity level for each portfolio as described in both formulas. I found that both portfolios have close averages levels of illiquidity. But the illiquidity of small enterprise portfolio is more volatile than that of medium enterprise portfolio. And to compare the effect of illiquidity shocks on returns between both portfolios, I feed the regression of returns of both portfolios on risks as follows. And our results are summarized in this table. We find that the estimated illiquidity beta during illiquidity shocks for portfolio returns of Saudi small enterprises fall more than those of medium enterprises. To conclude, illiquidity shocks on Saudi stock markets lower stock prices of small, medium enterprises, especially those of insurance sector. Except there is an exception for stock of real estate. Real estate management are not affected, are not impacted by market illiquidity. And the negative effect of market illiquidity shocks on stock returns is more stronger on small enterprises than on medium enterprises. We also notice that small and medium enterprises have the same degree of illiquidity, but illiquidity of small enterprises is more volatile. We also conclude that unlike prior studies that show that illiquidity shocks effect is stronger for more illiquid stocks, our study proved that this effect is stronger for stocks that have more volatile illiquidity degree, not more illiquid. Finally, I thank you very much for your listening and for your attention.